season of this market has been pretty good. It's not. Industrials has outperformed tech on a risk-adjusted basis. That's something that you don't usually see in a dead cat bounce. You say the same thing for utilities, right? There's a lot that's actually been under the hood that's actually been working pretty well, and there's still some value plays that are still out there. Should you keep your head on a swivel? I would, if you're kind of talking about just the Mag 7 and that's your only exposure. People are used to doing that over the last 5 years, 6 years. But if you actually look at some really decent chart setups, the risk reward is actually pretty decent right now. So I think the later tomorrow, I would be concerned. Kev's right, especially on energy. We probably won't see the full impacts of the energy move to the upside. If Cleveland Fed's right, you could have an upside surprise in the markets for tomorrow. And I think this is my just conspiracy theory here. President Trump, especially over this weekend, June 14th, he's having that parade. Obviously, we have the stuff going on in California. He's trying to squash that. He has trade talks going in. He would probably love to see all-time highs going into the weekend. That's just my take. I'm sure he's probably telling those trade representatives, get something for me to bring to the street and don't walk away until you do so. So I think that makes it a little bit more of a favorable market right now.
Yeah, I think that's everybody's goal, to get some positive news out of this. And, meeting for a couple days in a row, I'm sure that they're not going to come out and say, hey, we're in a stalemate, we're going to raise tariffs again. Either side coming out and saying that, I think that's pretty far-fetched. Maybe that's lending to some of this optimism in the equity market. But Kev, you mentioned earlier yields. We got a 3-year auction later on this afternoon, or after this show ends. It feels like the settlement, or at least a consolidation of yields at this point, is also lending support to the equity market, where we're not getting that volatility in the bond market right now, and that's actually a bonus here for equities.
Yeah, I think quiet. Remember, you ask bankers, what do they want? Higher rates or lower rates? Most of them will answer they want calm rates. They want quiet, and you're getting that right now in the bond market. I mean, the 10-year yield is very range bound. I think the numbers are for Wednesday, a 10-year note, $39 billion, and the Thursday's 30-year bond, $22 billion. I'm pretty sure those are the numbers that they're auctioning off. Those will be the two biggest ones, obviously, of the week. And Kev mentioned the 30-year bond. That'll be one everyone will be watching for sure, because that's just a bigger measurement. But the benchmark will be the 10-year. So, yeah, we're watching auctions more than we've ever watched them, Tom, and probably for good reason, right? We have more money to raise than before. So not a lot of earnings. Oracle and we got Chewy today. And then Oracle and Adobe are the biggest names of the week. We're getting late in earnings season, but I think headlines and inflation, are going to drive us here. And like I said, just be careful of the level of the VIX, because at 16.9 on the VIX, it can go lower, Tom.
Yep, I definitely can. Kevin, I'm going to give you one more opportunity, KG, here, as far as, valuations on the S&P 500. We mentioned it last week with Nathan Peterson. They're getting up there, the forward PE about 22. So it's elevated, right? But then earnings are supposed to start coming down this year. That doesn't equate to, higher asset classes here for equities at this point, does it? Or is that just maybe a low bar getting set here for equities moving forward?
Yeah, well, valuations are never a good gauge for what's going to happen in price, but it is expensive. But I think the market's, once again, kind of pricing in the fact that we're not going to see tariff rates being re-rated higher here. I think we've also come to the notion here, into an agreement that we will still see tariffs of some form, 10%, 15%. The market might have that kind of built in. And if you kind of think about it, a lot of the earnings that have been pulled is because of the uncertainty when it comes to the tariff policy. So if we start getting certainty back in, maybe those guidances become readjusted, come right back into that earnings moment here. I think the market, I hear what you're saying. The market is ahead of itself in some respects, especially technically. We have some gaps to the downside to focus on here. But I would be very shocked if we do see any type of really meaningful reversal in the downside, like a 2022 style market here. It seems like the market's kind of pretty much dug in that what we've experienced is the worst that it's going to get, and maybe we have some bright sides in the latter half of this year, even though the economic data could get a little bit hairy. And Kev's right. the problem that you have with the VIX is that it's so low. If you kind of look at the curve itself and the spread of that curve, it's so low. It's actually below the 1 standard deviation range we've seen for the last year. I would actually be a little bit more concerned that you have a re-rating higher rather than a re-rating lower for volatility. If it gets lower than this, it's going to be a very boring intraday trading session for a lot of those scalpers that are out there.
Yep. Hey, sometimes boring is good here from equity markets. There's not a lot of news moving equities at this point. All right, guys, let's take a quick break. When we come back, we're going to take a look at Alphabet, the Google parent stock. It's still up about 13% from its all-time highs, getting a nice 2% pop today, even though maybe there's some reports chatbots taking away some of their search business. We're going to talk Google Alphabet when we come back. Stick around. BBC.
You're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking Alphabet. The stock's having a nice day today, maybe on the back of some news out of Reuters that we're starting to see some information that OpenAI plans to add Google cloud service to meet its growing needs for compute at this point. Kevin, when you look at the stock, it's definitely out of the Mag 7 names, the cheapest on a valuation basis, but maybe that's due to, some of the headwinds out there. They're losing search business to chatbots, the potential breakup, maybe the divestiture of their Chrome business, maybe Apple not, going to use, Google search on their platform. I mean, there's a lot of headwinds, and then you throw in some, some fines out of the EU, which seem to be a recurring event, right?
Yeah, well, Google is such an interesting story because they seem to be, on the surface, under attack from everywhere, right? You mentioned EU regulators and then U.S. Regulators that want the company broken up. And the problems about search and their dominance and competition and all these things and some of their missteps with AI. So there's so many things, yet this company continues to power forward. And Tom, here's the counterintuitive thought for Google Alphabet. Bing has gained a little bit, not a lot, but a little bit of market share. Remember, Bing is by Microsoft. That negates the monopoly argument and could render all that lawsuit, all that just worthless. And so it could actually protect them against the regulators and the people that want them broken up. So the Bing uptick in market share is actually favorable for Google Alphabet. I know it's counterintuitive, but think of it that way. It disarms the government. Now, that said, it's rallied almost 18% in a month. It's still one of the cheaper Magnificent Seven names, Tom. And remember, they're in everything. They're in cloud. They're in streaming. They're in search. They're dominant in search. They're in AI. Are they a little behind? Possibly. But Google usually gets it right. They're just not always first in some of these things. So, yeah, I think that this is still a company of the highest quality. Now, without their problems, though, as you know, a lot of little issues coming up, but still a real quality company with a pristine balance sheet, Tom.
Yep, KG, the death of search here for Google Alphabet. It's been overhyped a little bit, but at the same time, we'll probably see over the next year or two if some of these chatbots are taking some market share away from them. But to Kevin's point, it's cheap at this point, but it's rallied $40 from those lows that we saw in April. Your thoughts here on Alphabet?
We're seeing some buyers really stepping in. Once again, this is one of those value plays that were presenting itself in the market about a month ago, and it's seeing some follow through right now, and it's having some positive headlines. Are we going to see ChatGPT and maybe some of these other AI chatbots take away from search? Over time, I think you will. The problem that you're going to have with those chatbots is their ability to actually monetize, because subscriptions are not going to be able to do it. And if they kind of bombard the responses with ads, that's also going to kind of deter the experience. So there is a kind of a double-edged sword there when it comes to the chatbots just in general. And Google has other streams of business here. It's a decent company. It seems like Sundar is doing a phenomenal job now. I mean, people wanted to see him out a year ago, but now they love him. So as long as they're able to just continue to maintain and show that they can print money, I think the stock is on the way to continue to see some gains over the next couple of months here. And the charts really kind of tell you that. If you look at the weekly chart, you do see a nice little crossover. This happened just last week, MACD cross and a bullish formation to the upside. And usually when you go back and you look at those technical crosses, it really does say that some follow through here is warranted for this trend.
Yeah, 50-day moving average down at 161, so only about $19 above that at this point, but it had been trending lower before turning positive. KG, got an example trade for us here. Walk us through it.
Yeah, looking at the July 18th 190 calls, buying this for $2.85. So the max loss on the trade is $285. Unlimited max profit with a break-even point of $192.85. Once again, once you get to that around that 195-ish area, that's a pretty key area of. Then once you get to that 195-ish area, that's a pretty key area of. Then once you get to that around that 195-ish area, that's a pretty key area of resistance point for this name. But it gives you a little bit of time, and if this momentum is going to up, that's going to potentially profit to the upside here. But you do need to have a move, but you do have about a month and a half in order for this move to really kind of come to fruition. And there is going to be a catch-up trade for value names that are out there. Google could be one that some large institutions might be trying to get into.
All right, yeah, let's break this one down. Pretty straightforward here on this one. July 18th monthly options, 38 days to expiration. The July 190 strike calls, paying roughly a $285 debit. There's your risk, $285 per put or per call that you buy on this one. Kev, when you look at this one, it's pretty straightforward. But as KG mentioned, you need a move. That break even of 192.85 is 7% above the current share price in there. And this is that type of trade, Kev, when we look at it, Even if the stock goes up to 188, 190, that it might not expand in price at all. Maybe implied volatility comes down. Maybe that call skew flattens out a little bit. So you definitely need to move on this one. But KG's given himself some duration on this one, Kev.
So buying the July 18th 190, it's not a high probability trade, but there is a time where this could be the most effective trade to do. Is it always? Probably not. It's not a high probability. You're paying theta. Your break even is the long strike, which is $10 above, plus the debit paid. So there is some paying theta. Your break even is the long strike, which is $10 above, plus the debit paid. So there is some risk there. But however, if you're right, $100, you have an unlimited upside potential. Now, we don't talk too much about naked long calls in this show, but there is a time where that might be it. If you think something is about to burst in Google Alphabet to the upside, remember, it's still a risk-defined strategy. It's got the chart that looks like the hockey stick. What you pay for this call is what you have. You are betting on a large move to the upside in Google Alphabet.
KG, when you look at this, just buying straight calls like this, needing to move to the upside, it does give you a little bit of flexibility, right? You're paying $2.85 per spread or per call on this type of trade. So when you're looking at trade management on this, say you get that move up to 190 in the next week or two, and this thing expands to $5, do you look to maybe, cover some of your deltas to the upside? Do you just sell a call that's above the 190 strike to offset some of the costs, maybe lock in some gains? Do you parse part of your position that you have on it? If you have multiple calls that you purchase, what's your outlook here?
Yeah, I mean, if you have multiple contracts, you can definitely try to take off some, and maybe you only leave the ones that kind of finance the trade on Carlos runners, or you can look at 2-to-1, risk reward ratio. It seems to be a decent one, but it kind of just depends on the trader. But here's the thing: we bring out a lot of diagonals and calendars. The thing that you get concerned about with Google, and you can see it with the price action right now, is that it moves too quick for a lot of those diagonals and calendars. And this is a stock that's right now average trading range every week, pretty much for the last, let's say, 4 weeks, 5 weeks or so, has been around $12. Before that, before we even had the drop, around $10. So it's definitely within the realm of possibility that it can get up to this level. You just need to have obviously suppliers continue to step in. You have the seasonality of equities doing pretty well in June and July, and you have announcements like this. So yes, there's definitely risk there, but when you kind of look at it from an overall portfolio standpoint, I don't want to call this a lotto, but this is one of those ones that you got to be willing to lose the premium here. But this could actually turn out to be a decent trade if it goes in the direction.
All right, good look at the straight call purchase there in Alphabet. All right, and thanks, Kevin Green, senior markets correspondent here, for joining us. But coming up after the break, we're going to be joined by Andy Swan from Lightfolio for a look at sentiment data in Chewy, the e-commerce pet retailer stock, up about 35% so far this year. The bar's getting high in this one going into earnings tomorrow morning. Stick around.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz. Actually, I'm seeing something from Schwab.
Uh-oh.
Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulty. Carl.
Wow. Schwab, a modern approach to wealth management.
You're an experienced investor or just getting started, Charles Schwab offers a webcast right for you. Do you like moving charts when analyzing stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. That's going to be Andy Swan, co-founder of Lightfolio. Welcome to the show, Andy.
Thank you.
All right, so we're talking Chewy. You know, this stock was dead in the water for a few years here. We've seen a little bit of a resurgence in some of their growth numbers, and with the stock, you know, basically at over 1 year highs. You know, are you guys seeing the same kind of data that the stock buyers are seeing here at this point?
Yeah, we were seeing the same kind of data that would have led to this sort of stock appreciation. But now we're starting to just see some yellow flags. We're starting to see some cracks in their digital traction. When we look at web visits for Chewy, it's pretty good. You know, 14% up 14% year over year. But that's really flattened out and decelerated over the last couple of months in a pretty concerning way. And then even more concerning than that is app usage. You know, the Chewy app is where most of their most loyal customers are using to make purchases. And we're seeing app usage down 28% year over year, which is an enormous number and really accelerating a downtrend in app usage, which tells us that, you know, Chewy is facing some significant competition. I think they're facing a lot of competition from the DoorDashes of the world, the Instacarts of the world, because, you know, you can order pet food delivered from a pet store or grocery store and get it within a couple of hours rather than relying on them shipping it across the country to you over the course of a couple of days. So, you know, Chewy's in, you know, I really respect what the company has done. I think they're really well run. I just think Wall Street's gotten ahead of itself in thinking that the recent acceleration that we've seen in all of their target metrics is definitely sustainable. I just think that we're starting to see at Lightfolio some data points that suggest, you know, that acceleration was great, but it's starting to stall out or even reverse to the downside. So I'm a little bit concerned going into this earnings call that the company is going to have some guidance or some KPI data points that disappoint investors, just hovering where it's at today.
Yeah, Andy, up 36% in the last 3 months. And you know how we know that it's run a long way? Mizuho yesterday lowered them from an outperform to a neutral, but raised the price target to 40. So that tells you how far this stock has run. But competition, everything I read, competition is their key problem. They're auto ship. They're in the right business. They're doing everything the right way. But sometimes you just can't stop the Amazons and Instacarts and these other companies that do. You know, I can not only get dog food, I can get other things as well. And they're such a boutique company, but they're, you know, people are so attached to their pets. I think they'll always have their little market share, but it's not like, how do they compete with these larger companies like this? I mean, all the good things they do, most of it you can still do on the other, on their competitors. So it's a tricky place to be, but this is a well-run company. Make no mistake, they do it right. They give people that love their pets, the concierge boutique attention that they want. The question is, Andy, is it enough?
Yeah, is it enough? And then I think, that competition is rising, and Chewy's, excuse me, like you said, Chewy's always going to have its loyalists. It's always going to have its extraordinary fan base, and they've earned it through the way that they treat their customers, the way that they execute orders and auto ship on time. They've earned that very loyal fan base, and I think that very loyal fan base is growing. It's the kind of lackadaisical users, that haven't been fully bought in, that I think are very susceptible to the DoorDash, to the Instacart programs that can, bring the same items to you within just a few minutes. I will say that we like the Chewy's Health division, very high margin vertical for them. Say year over year with really great growth, but that's a major cool down from what plus 300% earlier this year. So again, I think the company's doing well. I just think that Wall Street has anticipated an acceleration of this recent growth that simply, according to Lightfolio data, at least, is not materializing at this point. So that's when stocks get ahead of themselves, and a lot of times that's when stocks have negative reactions to what are overall pretty good we expect when they report.
Yeah, their last quarter they beat expectations, and revenue was up 14.9% year over year. So it was a pretty good quarter for them. So Andy, when you look at this as on an earnings score, yeah, you guys had positive data on it, but now with the stock parabolic since the last quarter results, got up to $48 a share, now around 45. I mean, are you guys still positive? What's your score on this one?
No, we're actually a negative 52, which is pretty bearish on this. It's just one of those where you say great company, going to be a good report, but the bar is just so high. We don't see, looking at the data that we have, we don't see how they get over it, and we don't see how they can come out on the earnings call with a whole lot of positive guidance into the future about these business units, because everything that we're seeing is that their customer base is solid and growing, but it's not accelerating its growth like Wall Street expects.
All right, great stuff. Great data as always, Andy. Appreciate it.
Thank you.
All right, that's Andy Swan, co-founder of Lightfolio, breaking down. It kind of sets up, Kevin, with that downgrade yesterday that we saw out of Mizuho, where they cut it to neutral from outperform but raised the price target on it. That maybe it sounds like from what Andy and Lightfolio have, it's run too far too fast at this point going into this report. So how do you want to look at this one from an example trade?
So I'm going to look at this strategy, and this is a strategy that you can look at and learn about and use or not use, frankly. And it's the iron butterfly, Tom. And so what I did, let's mildly good news, but the stock has run and maybe it consolidates up here or moves down ever so slightly. That's the vision that I see. And so what I looked at, Tom, I did everything in the July 13th, sold the 45 straddle, slightly below where we're trading right now, Tom. Then I bought the 47 call and the 43 put. I did that for about $1.70 credit, Tom. And think about this. You're short a $2 upside call vertical. You're short a $2 downside put vertical. You're collecting 170. If it stays here, you're looking to buy it back for as cheap as possible. And the risk, Tom, is the difference between the strikes, $2, and whatever credit you take in. If it's at 170, it's 30 cents. Trade about 173, 175, then it's 25 cents, Tom. So very low risk on this trade if you think there's a chance that Chewy stays range bound.
All right, yeah, let's break this one down. This is interesting because it's an earnings type example here where you're collecting a lot of credit and your risk is really low, but you've got to be right on this. So it's short iron condor, sometimes, as Kevin mentioned, referred to as a short iron butterfly, because you're selling the same the 45 45 call, selling the 45 put. 13th weekly cycle that expires in 3 days. Then you're buying the 47 strike call and buying the 43 strike put. So in essence, you're selling a straddle at the money, buying a strangle out of the money on the call and the put side, collecting roughly about $1.70 credit. That's what you could potentially make if it pins at or near 45. But it also gives you a range for this thing to still be profitable. A range of about 43.30 on the downside and then 46.70 on the upside on this one. In between those ranges is potential profitability on this, as I mentioned, with the apex profitability being at or near that 45 strike on this. Now, if you collect that $1.70 credit, as Kevin mentioned, the risk is really low. It's either $30 if it goes to the downside below 43 or above 47. Your risk is $30 only on this. Now, you've got some time on this spread, so even if it does open up right at 45 tomorrow, it might not contract in price. And that's the whole idea, Kevin, of this trade is you want it to contract in price where you can buy it cheaper because you've got two short options on that 45 strike on the call and the put. You'll have some assignment risk going into expiration. But the idea here is buy it for less than what you collected on this initial trade, right?
Exactly right. You're looking, remember, you're selling it first and then trying to buy it possible. And then remember, the break evens are, remember, you've only got the difference between $2 and whatever credit you take in. That's the risk on this trade. So it's very low risk, but the bet is that you're going to stay range bound at or near that $45 strike. Now, that's the theory cause you to put this trade on.
Yep. And the option market is in nearly a plus or minus $4 move either way. That's why you're collecting so much credit on this, because implied volatility levels in that option series where you're selling this short iron butterfly, that's why you're collecting so much option premium. A different type of trade, but you need some consolidation at or near that 45 strike. Pretty decent range on that one also. All right, let's take Microsoft. The tech giant is near all-time. Regained the crown as the largest market cap out there for companies. We're going to stick around. We're going to talk Microsoft when we come back.
Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Microsoft, let's get a quick look at markets, which are near session highs as we speak, awaiting some clarification on those talks between China and the U.S. The S&P 500 up nearly 0.4%. The Dow now up over 90 points or 0.2%. NASDAQ 100 up 0.35%. The Russell 2000 leading to the upside again, up 0.7%, getting close to its 200-day moving average, but still about 12% off of those all-time highs. You can see here from the heat map. It's still mixed as far as the 500 stocks in there, as far as between red and green. But we've got some leaders out there. Tesla up 3%, Google Alphabet up 2%, NVIDIA is positive, Meta Platforms is positive, but Microsoft, which we're going to talk about now, down a little bit here. So good look there at the markets. A little bit of optimism going into maybe some commentary from the U.S.-China trade relations here. Now, let's get into this discussion about Microsoft, because the stock settled at record highs yesterday. Coming off here in today's session, Kevin, it seems like last year all we did was sit there, pound our table, scratch our heads going, hey, why is Microsoft just flatlining, underperforming everything? It wasn't participating in the rally into the end of the year. It hit bear market territory first. It was a lagging member of the Mag 7. But now you've seen this resurgence since its last earnings report, and all the way up to all-time highs.
Yeah, it's amazing how different a short period of time can do in a name. I mean, the last 3 months, it's up 23%. Tom, that's a massive move for such a large cap tech stock. But what business are they in? They are not in it, right? Everyone's talking about, OpenAI. Oh, they invested in OpenAI in 2024, Tom. Before it was even invest in OpenAI and all this, they were early. Meta's deal for energy. Microsoft did that, right? They're so ahead of the curve on all these moves. They're a first mover in a lot of things, but the stock has rallied an incredible amount, Tom. And they're such a solid business model, but they've grown so much. Is it too far, too fast? This gap in that chart worries me over the long term. And let's face it, they're so widely held. They're in 3 of the 4 indices. They can't escape a global sell-off like we saw. So, yeah, this thing will go with the S&P 500, although right now it's outperforming, actually.
Yeah, and I think part of maybe the reason that we're seeing the resurgence here in Microsoft, besides the 0.7% pullback that we're seeing today, is maybe some of those investments in ChatGPT and OpenAI, which is nearly $13 billion, starting to pay off. There was a report that OpenAI seeing $10 billion in annual recurring revenue, and that's up from 5.5%, $5.5 billion at the end of 2024. So maybe some of those investments starting to pay off here. But as we mentioned, this stock lagged throughout much of 2024, the overall market here, but near all-time highs. So, Kev, I looked at a strategy that, hey, if you think this is going to continue and it's not immune, and maybe it's overextended on a technical basis, because that RSI is still above 71. It was above 76 on yesterday's close, so it's overbought on a technical level. That doesn't mean it can't continue to move higher, even though we're seeing that pullback. So I looked at a strategy that takes advantage and gives you some exposure to the upside, but you don't need it to explode to the upside, maybe 5-8% or something like that. you want it to continue to grind higher here. So looked out in the July 3rd weekly cycle, so just a few weeks until expiration on this one. We're going to buy an unbalanced call butterfly. We're going to buy one of the 470 strike calls that's currently just at the money. Sell two of the 485 strike calls, that's where you want it to go, and then buy one of the 490 strike calls. Paying a debit of roughly $5 on this one. So you've got $500 in risk on this trade per spread, right? But max profitability can be up towards $1,000, and that's at or near the 485 strike, which would be more fresh all-time highs on this one. But even if it goes above 490, it's a double in profitability. You lose a little bit, but at the same time, doing the unbalanced call butterfly as opposed to just maybe buying the 470, 485 call vertical, it's going to cost you less. You're going to have less risk, less exposure on this one. But Kevin, this is pretty straightforward. Your break even, anything above 475, that's only about $5 higher, is going to be profitability on this one.
Want a $15 call vertical, short of $5 call vertical, spending about $5. I mean, on a spread that can go to $15, Tom. So there it is. And if you're right directionally and Microsoft moves to the upside, you're insulated from losses or losing that profit on the upside, although it would peak out around the 485 level and then come down slightly, but hold profitability because you're long a bigger call vertical than you're short. The risk on this trade is the debit paid and the target $485, Tom.
Yeah, and Kevin, when you look at this trade like this, it's a bullish trade, right? But if you think the stock's going to go lower, maybe it's overextended. It's showing that on a technical basis. It's rallied so much to those all-time highs, and it's not immune to market, moves at this point. So if the market pulls back, Microsoft may pull back also. I just looked for reference, Kevin, just buying this same type of strategy, but buying it on the put side in that same July 3rd weekly cycle that expires in 23 days. If you bought the 470 put, that's at the money, sold the 455 put twice, and bought one of the 450 puts. So same setup, buying a $15 wide bearish put vertical and selling a $5 wide one to offset some of the cost. That'll cost you about $3.70 debit, so less debit. But Kevin, that would be the way that you would go if you were more bearish on a trade like this. In this example that we've got a bullish call butterfly, but the bearish put butterfly a little bit cheaper, but you'd need to move lower and kind of go against what we've seen in the market.
Yeah, I don't know the exact prices, but it sounds like the put skew is a little higher on the put side. And so you get more premium on the two that you sell, which would lower the net price of the butterfly, if that's the case. So yeah, a little bit cheaper entry point, net debit on the put side here, but same idea, right? Buying a bigger put vertical than you're selling directional play. You're about 22 deltas long on the call side. I'm not sure what the put is, but in this case, your long deltas, these are directional butterfly trades. So if it's the call side on the upside, it's bullish. Put on the downside, it's bearish.
Yeah, ACAP, real quick here, well, as we let you go, stocks at all-time highs, or not at session highs, not all-time highs, but it seems like the momentum still remains to the upside, still awaiting the China-U.S. deliberations, then also that 3-year auction that's coming up in about 5 minutes.
Yeah, I'm not as concerned about the 3-year auction as I am some headline coming out of U.S. and China. I think the 10-year on Wednesday, 30-year on Thursday is the big ones. But watching the VIX, Tom, 1680 now.
Yep. If it settles here, that'll be the lowest level since late February. All right. That's going to do it for us today here on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing is coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
No noise from Battle to Battle and beyond. Available anytime, anywhere, on any device for free.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Happy Tuesday, good afternoon, and welcome to Next Gen Investing. I'm Alex Coughlin. Let's take a look at where the market sits here as we approach session highs here in the midpoint of the trading day. We're up healthy, let's call it 25 points in the S&P 500, 60-30, and the NASDAQ 100 up as well, up about 0.4%. The Russell 2000 leads again as it's up about 0.75%, 2160. The Dow Jones, the laggard, but still up a comfortable 0.25 percentage point. You see volatility lower. You see treasuries relatively unchanged. Gold relatively unchanged as the market holds on to gains after weathering a little bit of intraday volatility earlier. Let's top out the show. Got a good guest here joining me. That's Kevin Green. You know him well, of course, senior markets correspondent across the Schwab Network. KG, we got CPI tomorrow. We got a 10-year auction tomorrow. Market does, though, seem to have firmed up here in the last couple hours. What do you make of today's trade ahead of those events?
Yeah, I think the market's really just focusing on what's happening over in Europe right now, where these trade talks see some of this enthusiasm taking place here. And obviously, we want to see some progress being made. And I think if we do, the market's going to try to rally off that. Now, you could also maybe question, is it a buy the rumor, sell the news type of event? Who knows? But I think that's really why we are seeing this kind of compression in this market. Even the move higher hasn't really been aggressive when it comes to volume outside of a couple of spikes here. But we do have some headlines coming out next couple of days. The economic data for CPI, market's expecting that to come in a little bit hot. And then looking at these 10-year and 30-year auctions as well, make sure there's enough demand out there in order to clear the supply. So still something that could create maybe a little bit of volatility, but right now we have some green on the screen. Getting a little concerned about the VIX trading at around that 16.8 level, though, Alex. It does seem like hedging opportunities are relatively cheap here. What do you think about the markets right now?
Well, one thing is for sure is we're really seeing the steepness of the volatility curve start to return. One day volatility reflects the quiet nature of the moves lately, with it down in the 12.5%, even with CPI and things still on the horizon. Volatility, though, the 30-day traditional VIX, like you said, just below 17. But you go out to like the VIX 3-month and it's closer to 20. So it does have a little bit more of a normal structure to it. But that steepness between time frames has returned, which does say that inventorying that volatility over time is quite expensive right now. But if you can time those hedges right, perhaps to your point, relatively affordable at the moment. Let's get into some of our movers, though, today, KG, because while the overall market is maybe spinning its wheels here a little bit, there's still quite a bit of independent stock-specific stories to cover. One of which is a pretty important name when it comes to the AI trade, particularly the AI hardware trade, and that's TSMC. Of course, the stock ticker drops to C, it's just TSM. But what do you make of this story here regarding their sales jump in May?
Yeah, seeing really incredible growth, sales growth of over 40% on a year-over-year basis. Year-to-date revenue growth up 43% on a year-over-year basis as well here. So obviously demand for artificial intelligence chips continues to rise, and that's where they're seeing pretty much a lot of this bread and butter profitability as well when it comes to top-line growth as well as the margin. Now, what's also very interesting that we kind of don't talk about a lot is also going to be handsets. Now, obviously that's been a little bit lackluster when you're looking at global demand, but that's really where Taiwan Semi also makes a fair amount of its money. So we do see these refresh cycles because of the Apple updates or what have you. That could also be a tailwind for this company. But overall, this just gives you that gauge that AI demand is still in full force. The demand for NVIDIA GPUs are still in full force here, and maybe we see an expansion